There's an American story that almost every kid in this country grows up hearing: work hard, save up, buy a house, build a life on something solid. For most of American history, that story was true. The house was one of the safest investments a working family could make. It built equity quietly while you slept. It was a hedge against inflation. It was a place to raise kids. It was, in the language your father used at the dinner table, something real. Then, between 2006 and 2012, that story turned on millions of Americans. The people who followed it bought the starter home, signed the mortgage, did everything their parents had said was responsible, lost their houses, their credit, sometimes their marriages. Meanwhile, the people who designed the system that took those houses largely kept their jobs, their bonuses, and their positions of power. This is the story of how the safest investment in America became a trap, and of a quiet schoolteacher named Dave who did everything his father had told him to do and lost it anyway. Meet Dave. Dave isn't one specific man. He's stitched together from millions of Americans who became first-time homeowners between 2003 and 2007. The back half of what would later be called the Great American Housing Bubble. 38 years old. Schoolteacher at a public middle school in a suburb outside Phoenix. Married to Sarah, also a teacher. 2 kids in elementary school, a small apartment they'd outgrown 2 years ago. Dave had heard the same advice from his father his whole life. Don't throw money away on rent. Own something real. It was the deepest piece of financial wisdom his father had ever given him. It was also, his father believed, the safest one. Dave wasn't trying to flip a house. He wasn't chasing a quick profit. He just wanted a bedroom for each kid and a yard small enough to mow on Saturdays. In the spring of 2006, after 4 years of renting, Dave drove with Sarah to a new development on the edge of town. Tract houses, all the same, beige stucco, 2-car garage, a yard the size of a postage stamp. The price was $280,000, more than they had thought they could afford, but the mortgage broker at the table was reassuring. Variable rate loan, the broker said. 3% for the first 3 years. Then it adjusts. But don't worry, you'll refinance before then. Prices in this market are climbing every quarter. By 2009, your home will be worth at least $350. It's the safest bet I can think of. Dave didn't fully understand the paperwork. Almost no one in that decade did, but he understood that everyone else in the room, the broker, the realtor, the loan officer, sounded like they did, and every single one of them was telling him the same thing. Buy now. Prices only go up. Sarah cried when they signed. The kids ran from empty room to empty room. They were homeowners. It was the worst financial decision either of them would ever make. To understand what happened to Dave, you have to look at what was happening at a level he had no idea existed. In the years after 2001, the Federal Reserve cut interest rates down to historic lows of around 1% to keep the economy moving through the dot-com bust and the aftermath of September 11th. Cheap money flooded into the financial system looking for somewhere to go, and it found one place above all others: American real estate. Between 2000 and 2006, U.S. home prices nearly doubled. In some markets, Phoenix, Las Vegas, parts of Florida, and California, they more than tripled. Houses became the hottest investment in the country, and Wall Street wanted in. This is the part most ordinary Americans never saw, but it mattered more than anything else. Banks had figured out they could bundle thousands of individual mortgages together into giant bonds, instruments called mortgage-backed securities. They could sell those bonds to pension funds, hedge funds, foreign governments, anyone hungry for yield in a world where safe assets paid almost nothing. There was only one problem with this business. To keep selling these bonds, the banks needed more mortgages, a lot more. They had used up most of the buyers who could comfortably qualify under the old rules, so they began lowering the standards for what counted as qualified. By 2005, banks were issuing what came to be known as subprime loans, mortgages to borrowers with poor credit, low down payments, or no documented income. Some loans required no proof of income at all. The industry nicknamed them liar loans. Others required no income, no job, and no assets. Those were called ninja loans. Nearly everyone who walked through the door of a mortgage office in 2005 walked out with a loan, often with terms they did not understand and could not afford if interest rates ever moved against them. Wall Street kept buying these loans, packaging them, and selling them on. The ratings agencies, Standard and Poor's, Moody's, Fitch, kept stamping the bonds with their highest possible ratings, AAA, the same rating given to United States government debt. An insurance giant called AIG wrote contracts insuring the bonds in case they ever defaulted, collecting fat premiums for what everyone agreed was risk-free money. The whole thing, every loan, every bond, every AAA rating, every insurance contract, depended on one assumption. Home prices would keep going up. Now, back to Dave. Dave's variable rate mortgage was scheduled to reset to a higher rate in 2009. The broker had told him not to worry, he would refinance before then. That assumption depended on his home being worth more than he owed, which depended on prices continuing to rise. In late 2006, prices in Phoenix stopped rising. By mid-2007, they were falling. By 2008, Dave's home, for which he had paid $280,000, was worth about $200,000. By 2009, when his mortgage rate adjusted upward and his monthly payment nearly doubled, his home was worth less than $180,000. He owed far more than the house was worth. He could not refinance because no bank would lend against a property that had lost so much value. He could not sell because the sale would not cover what he owed. He could only stay and watch his payments swallow more and more of his teacher's salary. Dave had walked into a trap that thousands of people he never met had built, brick by brick, over years he had paid no attention to. In September 2008, the pyramid collapsed. Lehman Brothers, one of the oldest investment banks in America, filed for bankruptcy on September 15th. Within days, AIG, the insurance giant that had written contracts guaranteeing the value of trillions of dollars in mortgage bonds, was hours from failure. The United States government faced a choice: let the financial system collapse and risk a second Great Depression that would punish everyone, including Dave, even more brutally, or step in. It stepped in. The government rescued AIG with $182 billion. It rescued Citigroup. It rescued Bank of America. It rescued the giants. In total, Congress authorized a $700 billion program, the Troubled Asset Relief Program, or TARP, to inject cash into the financial system. The Federal Reserve made trillions more in emergency lending available behind the scenes. The argument for the bailout, then and now, is straightforward. If the major financial institutions had failed, the credit system that holds the modern economy together would have frozen. Unemployment, already terrible, would have gotten much worse. Many serious economists believe the rescue prevented something much darker than what actually happened. That argument has merit, but look at what happened to ordinary borrowers in the same period. Between 2006 and 2014, by widely cited industry estimates, roughly 9 to 10 million American homes were lost to foreclosure. Dave was one of them. In 2010, after 18 months of falling behind, Dave handed his keys to the bank and moved his family into a small 2-bedroom rental. His credit was destroyed, the down payment, the closing costs, the years of mortgage payments that had built almost no equity, all of it was gone. In the same window, fiscal year 2009, Goldman Sachs, one of the firms at the very center of the crisis, set aside roughly $16 billion for employee compensation and bonuses. Other bailed out banks paid similar packages. Almost no senior executive at any major bank lost their position as a direct result of the crisis. Almost none faced criminal prosecution. The financial institutions, with very few exceptions, kept their leadership, their bonus pools, and their political access. Dave, and millions like him, lost their homes. To be fair, and this video is going to keep being fair, this is contested ground. Supporters of how the crisis was handled argue that the bailouts were ugly but necessary. Without them, unemployment might have climbed far higher than the 10% it actually reached. Damage to homeowners like Dave would have been even worse. They also note that most TARP funds were eventually repaid with interest to taxpayers, and they argue that many of the loans that failed went to borrowers who never should have qualified. Borrowers who, in this view, also bear some responsibility for signing terms they could not afford. Critics argue something deeper. They argue that a system was constructed to enrich a small group of people during the boom and then to socialize the losses among ordinary borrowers during the bust. The losses didn't disappear. They were moved from the institutions that caused them to the homeowners who trusted them, not by accident, by design. Both readings have a point. But for Dave, sitting in his new rental in 2011, watching the news from the bank that had taken his house announce a record bonus year, the argument was abstract. The loss was not. That is the lesson that burned itself into a generation. Not buying a house is risky, something quieter and much harder to shake. When the rules change, the people who write them survive. The people who followed them rarely do. Dave eventually rebuilt. Slowly. He kept teaching. Sarah went back to work full-time. Their marriage strained almost to the breaking point in 2011, but held. By 2015, they had savings again. By 2018, they were renting a modest house in a better school district. But Dave never bought another home. When his daughter, in her late 20s, asked him about buying her first place, Dave didn't give a lecture. He just said something she didn't fully understand until years later. A house is shelter. That's all it has to be. The moment someone tells you it's also an investment that can't lose, walk out of the room. That sentence is the whole story. Dave wasn't bitter. He wasn't anti-capitalist. He was a public school teacher who had trusted a system that had been designed at its highest levels in a way he had no chance of understanding, and who had paid for that trust with the house his children grew up in. And memory like that doesn't stay with one man. It gets passed down to a daughter who can't bring herself to sign a mortgage even when her friends are buying, to a son who lives in a small rented apartment in his 30s and refuses to be moved, to a generation that may spend its entire working life renting because the wound from 2008 is one of the deepest financial wounds in living American memory. You, watching this, may have been a child in 2008. You may not remember the headlines. You may remember only that your parents seemed tense for a long time and never quite explained why. But you are still living in Dave's shadow. Every time you scroll Zillow and feel a knot in your stomach you can't fully explain, that's Dave's shadow. Every time a parent says, "Don't rush it, kid, the housing market always finds a way to take it back," that's Dave's shadow. Every time someone your age tells you they will never buy because the system is rigged against people like us, that's the shadow of a crisis whose victims have not stopped remembering. And the shadow shapes the present even when the present looks different. By the mid-2020s, American housing affordability had reached its worst level in 2 generations. The median home cost more than 5 times the median household income, a ratio that earlier generations would have considered structurally impossible. Different crisis from 2008. Same underlying question. When ordinary work cannot reach the most basic American asset, what is left of the dream? So the real question isn't what happened in 2008. It's whether the lesson still applies. And I'm not going to answer that for you. I'll give you two ways to see it. 1. 2008 was a once-in-a-century systemic failure that has been studied, regulated, and corrected. The Dodd-Frank reforms reshaped how banks operate. Mortgage standards are far tighter than they were during the bubble years. Stress tests, capital requirements, consumer protection rules, the system has learned. Buying a home today, with reasonable diligence and a fixed-rate loan, is once again what it was for most of American history. The safest way an ordinary family can slowly build wealth. 2. Every generation thinks the rules have been fixed for good. Every generation eventually finds out otherwise. The specific structure of 2008 may never repeat, but the pattern that the people closest to power tend to survive when the rules change, while the people who followed those rules often pay the price, is older than this country. And the people who learned nothing from Dave will, when the next version of 2008 arrives in some unfamiliar shape, be among the first ones hurt. Which view is right is up to you. But you should know you're not choosing in a vacuum. You're choosing in the long shadow of 2008, of Dave, of the keys handed back to the bank, and of one of the deepest financial wounds this country has experienced in living memory. For millions of Americans, the safest investment in the country became the worst decision of their lives. Most people younger than 30 have only the dimmest memory of why. So before you decide your parents' fear of mortgages is just paranoia, ask yourself one thing. Did they not understand the housing market, or did they live through something about it that you haven't had to learn yet?